Welcome to our channel where we explore the world of investments. Today we're diving into the exciting realm of Canadian monthly dividend ETFs. Now, if you're wondering what exactly an ETF is, it stands for Exchange Traded Fund. It's a type of investment fund and exchange-traded product traded on stock exchanges, much like individual stocks. But why are we focusing on Canadian monthly dividend ETFs specifically? Well, these financial instruments have unique features that set them apart. They provide regular monthly income, which can be a great advantage for investors seeking steady returns. Not only that, investing in Canadian ETFs can provide exposure to a diverse range of sectors in the Canadian market, spreading the risk and potentially increasing the reward. So whether you're an experienced investor or just dipping your toes into the investment world, Canadian monthly dividend ETFs are worth considering. So gear up as we delve deeper into Canadian monthly dividend ETFs. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. One of the most prominent Canadian monthly dividend ETFs is the Vanguard FTSE Canadian High Dividend Yield Index ETF, or VDY for short. VDY is a heavyweight in the world of exchange-traded funds, known for its focus on large-cap Canadian companies that have a history of paying out high dividends. This ETF's primary strategy is to track the performance of a broad Canadian equity index that focuses on dividend-paying stocks. It's a strategy that has proven quite successful, as VDY consistently ranks among the top Canadian dividend ETFs in terms of total return. Let's take a closer look at its asset allocation. VDY primarily invests in financials, with a hefty allocation of the portfolio to this sector. Energy and utilities also make up a significant portion of the fund. The remainder is spread across various sectors like telecommunications, consumer goods, and industrials. This diversified allocation helps to spread risk and offers exposure to a wide range of industries. Now, onto its top holdings. Some of the largest and most well-known companies in Canada, such as the Royal Bank of Canada, Toronto Dominion Bank, and Enbridge Inc., are part of VDY's portfolio. These companies have a long-standing history of paying dividends, contributing to the ETF's high yield. In terms of performance, VDY has consistently offered a solid yield, making it an attractive option for income-seeking investors. However, like any investment, it's not without its risks. The heavy allocation to the financial sector means that any downturn in this industry could significantly impact the ETF's performance. Also, because it's tied to the Canadian market, it's subject to the country's economic health. Despite these risks, the benefits of investing in VDY are substantial. It offers a high yield, diversification across several sectors, and exposure to some of Canada's top dividend-paying companies. Plus, its low expense ratio makes it a cost-effective choice for those looking to add a dividend-focused ETF to their portfolio. VDY certainly offers an interesting proposition for those seeking a steady stream of income. Another major player in the field of Canadian monthly dividend ETFs is the iShares S&P/TSX Composite High Dividend Index ETF, better known as XEI. This fund is a heavyweight in the dividend investing world, and for good reason. XEI follows a unique investment approach. It's designed to mirror the performance of the S&P/TSX Composite High Dividend Index, which consists of 50 of the highest yielding companies on the TSX Composite Index. This strategy allows XEI to offer investors a broad exposure to the Canadian equity market, focusing on companies with a strong history of paying dividends. Now, let's take a look at the asset distribution of XEI. It has a balanced portfolio that spans across various sectors. Financial services, energy, and utilities make up a large part of its holdings, but it also stretches into sectors like telecommunications, consumer discretionary, and industrials. This diverse allocation helps to mitigate risk and provides a steady flow of income. In terms of top holdings, you'll find a roster of well-established, high-yielding companies. These include the likes of Royal Bank of Canada, Toronto Dominion Bank, and Enbridge Inc. This indicates that XEI leans towards blue-chip stocks, providing investors with stability and consistent returns. When it comes to performance, XEI has shown a steady growth over the years. It has maintained a high yield, which has been particularly attractive to income-focused investors. However, like all investments, it has its share of ups and downs, so it's important to consider your risk tolerance and investment goals. XEI does have potential advantages and disadvantages. Its diversified portfolio and high yield make it attractive, But as it's tied to the Canadian market, it might be affected by domestic economic changes. Also, the heavy focus on financial and energy sectors could be a concern if these sectors take a hit. In conclusion, XAI, with its diversified portfolio and attractive yield, is certainly worth considering. It offers a unique blend of stability and income potential, making it a compelling choice in the landscape of Canadian monthly dividend ETFs. Now that we have a fair idea about VDY and XEI, let's see how they stack up against each other. When we compare VDY and XEI, we notice that both these Canadian ETFs have different strengths. Let's start with yield. VDY, or the Vanguard FTSE Canadian High Dividend Yield Index ETF, is known for its high dividend yield, which is a result of its focus on large-cap stocks with a strong track record of paying dividends. On the other hand, XEI, or the iShares S&P/TSX Composite High Dividend Index ETF, offers a slightly lower yield but compensates for this with its broader diversification. Speaking of diversification, it's another key point of difference between these two. VDY is heavily focused on the financial sector, which makes up a significant portion of its portfolio. Meanwhile, XSAI has a more diversified portfolio, spreading its investments across various sectors such as energy, utilities, and real estate. This broad diversification can help reduce risk and volatility, which brings us to our next comparison point, volatility. In terms of volatility, XEI's diversified portfolio helps it maintain a lower level of volatility compared to VDY. However, keep in mind that lower volatility often comes with lower potential returns. VDY, with its focus on high-yielding stocks, may experience higher volatility but also offers the potential for higher returns. Now, who should invest in which? If you're an investor with a higher risk tolerance looking for high yield, VDY might be more suitable for you. However, if you prefer a more balanced approach with lower volatility, XAI could be a better fit. It's important to note that both these ETFs are not mutually exclusive. You might choose to hold both in your portfolio to benefit from both high yield and diversification. Though both VDY and XEI have their strengths, your choice would ultimately depend on your investment goals and risk tolerance. It's clear that Canadian monthly dividend ETFs, particularly VDY and XEI, offer compelling opportunities for investors. As we have journeyed through the realms of these investment vehicles, we've highlighted their potential and key characteristics. VDY, the Vanguard FTSE Canadian High Dividend Yield Index ETF, is a powerhouse of a fund that focuses on Canadian companies known for their high dividend yields. It's a great choice for those looking for steady income streams and exposure to the Canadian market. On the other hand, XEI, the iShares S&P/TSX Composite High Dividend Index ETF, offers a wider exposure to Canadian companies, focusing not just on high yield but also on sustainability of dividends. It's a solid choice for those who value a diversified portfolio and are comfortable with a slightly higher risk for potentially higher returns. But remember, every rose has its thorn. While these ETFs come with attractive features, they also carry their share of risks. The high dividend yields could be a result of financially distressed companies, and the focus on a single market, Canada in this case, could limit diversification benefits. So, what's the takeaway from all this? It's simple. Understand your investment objectives and risk tolerance. Are you looking for a steady income stream, or are you comfortable taking a bit more risk for potentially higher returns? Your answer to these questions will guide you in choosing the right ETF. Investing is not a one-size-fits-all game. It's about finding the right fit for you. It's about understanding the nuances of each investment opportunity and making informed decisions. And that's where we come in. Our goal is to provide you with the information you need to make those decisions. We delve into the intricacies of different investment vehicles, dissect them, and present them to you in a digestible format. We aim to make the complex world of investing a bit easier to navigate. In the end, investing is about more than just making money. It's about securing your financial future. It's about making your money work for you, and that's why it's crucial to understand the ins and outs of the investment vehicles you choose. We're here to guide you on your investment journey. We're here to help you understand the world of investing, and we're here to help you make informed decisions. So whether you're a seasoned investor or just starting out, we've got you covered. And with that, we've reached the end of our deep dive into Canadian monthly dividend ETFs. We hope you found this journey as enlightening as we have. If you found this video helpful, make sure to subscribe to our channel, hit the like button, and share this video with your friends. Stay tuned for more informative content on investing.